Hello friends, welcome to this month's debt market update of Sundaram Mutual Fund. The bond yield continued their upward journey during the month as the theme for the bond market remains to be the surge in inflation. During the month, the conflict between Russia and Ukraine further aggravated the commodity prices and disruption in the supply chains. This led to a sharp rise in the inflation. In US, inflation reached multi-decadal high of 7.9%. In India also, second month in a row, inflation printed above the RBI's upper band of the tolerance range of 6%. This led to the rise in the bond yields. For example, US 10-year bond rose more than 50 basis points and closed the month at 2.34% compared to 1.82% of last month. In the domestic market also, yields rose by anywhere between 7 basis point to 20 basis point. The lowest hit was on the government 10-year bond, as during the month there was no fresh supply from the government, and the bond yield closed 7 basis point higher than the last month at 6.84% compared to 6.77%. However, the pure interest rate play product, which is not disturbed by the demand and supply factors, is the overnight interest rate swap. There we saw the rise in the yields by anywhere between 16 basis point to 21 basis point from 1 year to 5 year, which is the most liquid segment. Similarly, in the money market and corporate bonds also, we observed a rise of anywhere between 10 to 20 basis point across the yield curve. The persistently high inflation has led to change in the action and commentary of the most global central banks. In US, the FOMC in its latest meeting in the month of March announced the first rate hike of 25 basis point and also gave a very hawkish guidance on the start of the quantitative tightening program and said that it could start the quantitative tightening program as soon as in the very next meeting in the early May. Later, from the minutes of the meeting, it was revealed that there was a by and large agreement between the committee members to roll off the balance sheet by a quantum of $95 billion per month. Similarly, in its March meeting, the ECB also announced that it is now looking to end its quantitative easing program early than what was envisaged earlier, and said that they could end the quantitative easing program by this year end compared to the previous announcement of continuing it till 2023. In India also, in its first bi-monthly monetary policy meeting for the new financial year on 8th of April, RBI though kept the policy rate unchanged. However, it introduced a new standing deposit facility as the new floor of liquidity adjustment facility at 3.75%. This would effectively mean that now the lower bound of the LAF will be 3.75 instead of the reverse repo rate of 3.35%. This would mean is that now the overnight rate in the market would be closer to 3.75% compared to the earlier rate of 3.35%, and hence the whole curve will get priced accordingly. We observed that with this announcement, which was a bit unexpected from the market point of view, as the market was expecting a status quo from the Reserve Bank on this policy. The RBI also tweaked its forward guidance from accommodative as long as it is required to accommodative with focus on withdrawal of accommodation. This marks a significant change and paves the way for change of policy stance to neutral in the coming policy. RBI also also changed its outlook on growth and inflation. RBI significantly revised its inflation projection from 4.5% for financial year 2023 to 5.7%. This was a significant uptick, and as pointed out in the previous monthly updates, that the earlier forecast of RBI was off by anywhere between 50 to 100 basis points compared to market participants. However, this time RBI announcing that due to the ongoing conflict between Ukraine and Russia, market dynamics have changed and they revised their inflation outlook, which now by and large in line with most of the market economists. RBI, acknowledging the impact of high commodity prices, also revised its growth projection downwards to 7.2% compared to 7.8%. To boost the demand for government bonds, RBI also extended the HTM guideline from 31st March 2022 to 2023 and also extended the HTM limit from 22% to 23% till 31st March 2023, post which RBI will gradually lower this limit to 19.5%, which is the current standard limit before pandemic. This introduction of this new liquidity management framework, where the lower bound would be 3.75% and upper bound would be the marginal standing facility of at 4.25%, effectively means that RBI has now changed the left corridor back to pre-pandemic levels, and this is the start of the withdrawal of ultra accommodative policy, uh, and paves the way for change of stance in the coming policy, and further the rate hikes in the coming policies. We believe that with this change in RBI stance, RBI is trying to move away from behind the curve to catching up with the market, and we believe that we can see a rate hikes of anywhere between 50 basis point to 100 basis point in the next year or so. In terms of impact of this policy stance on the market, we observed that since it was a bit market caught off a bit off guard with this announcement, we saw a sharp rise in the yields. In the government bonds, we observed a rise of 20 basis point to 30 basis point across the curve. The OIS curve rose anywhere between 30 to 40 basis point, and we observed 10 to 20 basis point rise in the money market and corporate bond curve. Going ahead, we believe once this Russia-Ukraine conflict settles, focus will again revert back to inflation, growth dynamics, along with the government bond supply. Looking at the inflation, for now it seems that it is going to remain in and around 5.5 to 6% sort of band, which is largely the base case for now. However, given that there are too many moving parts, we will be keeping a close eye on this, because if this the current conflict between Russia and Ukraine gets extended, then oil prices may take a while before they come off. Also, there are other items like metals, which has risen. Also, the wheat prices, the oil seeds, can remain high, and which will definitely have an impact on inflation. On the growth, these high commodity prices will have a negative impact on the growth as well, and which is reflecting in the recent change in the RBI's growth outlook as well, which they revised downwards. And if we look at barring the H1, which is actually the main reason for even the 7.2 sort of a number, the growth outlook for third and fourth quarter of the financial year is 4 to 4.5%, which is quite on the lower side, which would mean that which would mean that you will have lower growth on tax collections as well, and also the lower nominal GDP number, which will impact the overall fiscal deficit numbers. In terms of fiscal deficit and external deficit, which can have a big bearing on the inflation and the government bond supply. on the fiscal deficit, the numbers are already on the higher side, and the overall nominal GDP growth will further change this. In terms of big factors, if you look at affecting this, the last year the tax collections were pretty robust, and if that continues to be the case in this financial year as well, then that would work out as a positive. The other factor which can positively impact the fiscal deficit is the divestment targets, which government can overachieve if they successfully complete the LIC and other divestments. Also, government can get benefit from the 5G telecom auctions, which can add to the kitty, which is not taken for in the budget accounts. On the negative side, the higher commodity prices, particularly the energy prices, can have a negative impact. Firstly, from the fact that the government will have to pay up the higher fertilizer subsidies and other subsidies on telecom and gas products. Sorry, on fuel and gas products. At the same time, if they have to cut down on the excise duty, which they have enjoyed last year. If the oil prices continuously remain high, they have to cut down on that, so that will also reduce their revenue collections. So for the time being, it seems the situation is rather balanced, but we need to keep a close eye on that. In terms of external deficit, it has already risen. The last year's the third quarter's current account deficit number has risen to 2.7% of the GDP compared to 1.3% in the previous quarter. And if you look at, this was largely driven by the higher trade deficit number. And if you look at for last 4 or 5 months, we have continuously seen the trade deficit number rising to 20 billion and or higher. Even in December, touched the high of close to 23 billion in a month, which was quite high. And this can lead to higher current account deficit, and changing BOB dynamics can put pressure on the currency. And if the currency depreciates, that will further add to the inflation. Overall, if you look at we expect interest rates to gradually rise as the higher inflation and the change in the RBI stance to slowly and steadily withdraw the extraordinary accommodation provided during the pandemic years would lead to gradual rise in interest rates. However, we believe that RBI will continue to support the interest rates by continuously, buying the government bonds and intervening in the government bond auctions, which will keep the bonds well bid, and the rise in the bond yields a gradual and controlled one. In this scenario, the carry becomes the significant part of the fixed income portfolio strategy, and to get the maximum benefit out of that, investors should align their portfolio strategy in line with their investment horizon and portfolio duration, which would mean that investors looking for shorter tenor deployment can look for actively managed short-end products like ultra low duration or short duration sort of product, whereas the investors looking for longer tenure investment to take the benefit out of indexation advantage in taxation can look for short to medium duration strategy sort of products like laddering strategy or roll down maturities that matches with their investment horizon. With this, we'll wrap this edition. Thanks. Stay safe, stay invested.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.